Welcome back to Explain the Charts, your ultimate destination for insightful market analysis. Today, we're putting EURUSD under the microscope, a currency pair known for its significant responsiveness to global economic shifts and central bank policy. As of July 30th, 2025, the overarching narrative dominating financial headlines points to a strengthening U.S. dollar. Recent Google searches confirm this, highlighting upbeat U.S. economic data and a Federal Reserve that, according to Chairman Powell, is holding off on any definitive September rate cut verdicts. This hawkish undertone from the Fed, or rather, the lack of a dovish pivot, directly contributes to dollar strength, impacting the euro's performance. Let's begin our deep dive by examining the broader picture on the daily chart, spanning from early 2024 to the present. Observe the prolonged downtrend we witnessed in late 2024, with EURUSD consistently losing ground and eventually finding a critical floor around the 1.01 to 1.03 price range in early 2025. This period of notable dollar appreciation, fueled by tighter monetary policy expectations, perfectly correlates with the news reports of the Eurozone currency hitting multi-week lows during that time. The increased volume during those significant bearish impulses indicated strong institutional selling pressure, confirming the market's conviction. Such sustained periods of decline often precede significant reversals, but the timing is always key for traders. The resilience shown at these lower levels around 1.01 acted as a strong demand zone, setting the stage for subsequent movements. Shifting our focus to a more recent time frame, specifically from late November 2024 through July 2025, we can pinpoint a significant reversal and subsequent uptrend. Following the profound lows in early 2025, the pair began to recover, forming a clear sequence of higher lows and higher highs, clearly indicating a robust shift in momentum towards bullishness. This bullish momentum became particularly pronounced in March and April 2025, with EURUSD breaking decisively above the 1.10 psychological barrier, turning previous resistance into new support. We saw the pair soar, reaching highs around 1.157 in April, undergoing a period of healthy consolidation, before an impressive final push towards the 1.183 level by early July. This 1.183 mark now stands as a critical long-term resistance, representing the peak of this impressive multi-month rally and a significant hurdle for any future bullish attempts. However, as we entered the latter half of July, the market narrative began to shift dramatically once again. The recent streak of robust U.S. economic data, coupled with Fed Chair Powell's explicit statements about not rushing rate cuts, has reignited strong dollar demand, leading to a sharp and rapid pullback in EURUSD. The daily candles from July 28th and 29th illustrate this perfectly, forming large bearish engulfing patterns with increased volume, unequivocally signaling strong seller conviction and a potential short-term reversal from the preceding uptrend. The price has rapidly retraced from levels near 1.175, breaching several intermediate support zones with ease, to trade currently around the crucial 1.155 area. This 1.15 level is highly significant, acting as a crucial psychological support that was previously a strong resistance point back in April and May. Its integrity is paramount for short-term sentiment. If this level holds, it could provide a base for consolidation or a bounce, but a decisive break below it would open the path to much lower prices. Specifically, a break below 1.15 would likely target the 1.12 area, which served as a significant support floor in May. The elevated volume on these recent bearish candles further validates the strength and conviction behind this current downturn, suggesting fundamental factors are driving the price. Moving to the 1-hour chart, we gain a more detailed perspective of the hourly movements leading up to the very recent dramatic price action, keeping in mind our data range for this time frame ends July 15th. During the period from July 10th to July 15th, we can observe the initial signs of weakening in the euro, as the price struggled to sustain levels above 1.17, indicating increasing selling pressure at those highs. Notice the tight consolidation around 1.167 to 1.169 during this period, characterized by smaller hourly candles and reduced volatility, signaling indecision in the market. Repeated attempts to break higher were met with swift rejections, forming bearish wicks that foreshadowed the broader bearish sentiment that has now fully manifested across larger timeframes. This hourly hesitation, even before the major news-driven drops, suggested that the bullish momentum was beginning to wane. The quick dips and recoveries within tight ranges also show the immediate reactions of intraday traders to microeconomic data points and liquidity shifts. A decisive breakdown from such consolidation patterns, especially when confirmed by increasing selling volume, often accelerates the move in the direction of the breakout, as we subsequently observed on the daily chart. Thus, even without the absolute latest hourly data, this time frame highlights the early warning signs of a momentum shift. Now, let's drill down even further into the 15-minute chart, providing us with the most acute insights into the very latest price dynamics, specifically covering the intense trading on July 28th and 29th. Here, the rapid nature of the recent decline is vividly displayed, showing a succession of significant bearish candles on Monday, July 28th, driving the price from near 1.175 down towards 1.158. Each of these bearish candles, often with extended bodies and minimal lower wicks, unequivocally signifies aggressive selling interest and a clear dominance of bears following the market's reaction to the strong U.S. economic news. On Tuesday, July 29th, the selling momentum persisted, albeit with some minor bounces, ultimately pushing the pair even lower to critically test the 1.155 support zone. Crucially, observe the volume spikes accompanying these major down moves. Higher than average volume during these drops strongly reinforces the strength and validity of the current bearish trend. Currently, the 15-minute chart shows price consolidating tightly around 1.155, characterized by very short, choppy candles in the most recent hours of trading. This tight consolidation could signify a momentary pause as traders digest information and institutional players accumulate positions, but without strong bullish candlestick patterns or increasing by volume. It does not yet immediately suggest a reversal. For agile intraday traders, the key levels to monitor are the immediate resistance at 1.158, representing the top of this consolidation, and the critical support at 1.1518, which marks the low of the July 29th daily candle. A decisive break and sustained close below this 1.1518 level on the 15-minute chart would strongly signal further downside continuation, potentially triggering stop losses and accelerating the move. Conversely, any substantial move back above 1.158 could signal a minor relief rally, but it would need to clear 1.165 with conviction to truly alleviate the intense bearish pressure observed. Always consider the volume-weighted average price, VWP, on these smaller time frames. Price trading consistently below VWP during this consolidation further reinforces the underlying bearish sentiment. This indicates that the majority of trading volume is occurring below the average price, suggesting sellers are in control. Therefore, short-term strategies should lean bearish unless there's a clear and forceful breakout to the upside. To summarize our in-depth analysis for EURUSD as we stand on July 30th, 2025, let's bring it all back to the daily chart for a holistic view. While the past few months showed a significant long-term rebound from early 2025 lows, the recent short-term price action, primarily influenced by U.S. economic strength, is now decidedly bearish. Our most critical immediate support level is the 1.15 handle, which possesses significant historical importance as both a former resistance point and a current psychological barrier for the pair. Should this 1.15 support fail, we would then look towards secondary support around 1.12, a level that proved resilient during the May 2025 lows. Below that, the strong demand zone between 1.01 and 1.03 from early 2025 remains the ultimate long-term support. On the upside, immediate resistance exists at 1.165, representing the recent consolidation breakdown point on the daily chart, followed by 1.17, which was a strong previous support level. The major resistance for any substantial long-term recovery would undeniably be the July 1st high of 1.183, a level that indicates strong supply. Considering the persistent news flow indicating US dollar strength and the clear bearish technical signals, a sustained break below 1.15 and a subsequent move towards 1.12 appears to have a 65% likelihood. This bearish scenario would be strongly reinforced by continued hawkish statements from the Federal Reserve, further positive surprises in U.S. economic data, or any signs of escalating economic weakness from the Eurozone. Conversely, a strong bounce from 1.15, particularly if accompanied by an unexpected dovish shift from the Fed or significantly weaker U.S. data, could see price attempt to reclaim 1.165 or even 1.17. Though this currently carries a 35% likelihood. A true long-term bullish reversal would necessitate price not only breaking cleanly above 1.17, but also establishing a new higher low and higher high structure, which seems less probable in the immediate future given the current market dynamics. For prudent traders, it's crucial to diligently watch for confirmation of any breakouts, whether bullish or bearish, on both the 15-minute and 1-hour charts if the 1.15 level is tested. Volume confirmation will be key here. A high-volume breakdown is more convincing than a low-volume one. Additionally, keep a sharp eye on upcoming macroeconomic announcements from both the US and Eurozone, particularly inflation data, employment figures, and any further central bank speeches, as these will be paramount drivers of future price action. These events can rapidly shift market sentiment and provide the necessary catalyst for the next significant directional move in EURUSD. Always prioritize robust risk management and combine thorough technical analysis with a deep understanding of fundamental news for well-informed trading decisions. That's all for today's in-depth analysis on EURUSD here on Explain the Charts. Don't forget to like, share, and subscribe for more essential market insights and educational content. We appreciate your support, and we'll see you next time.